Hi, welcome to Let's Talk Bonds, the weekly podcast from Minor Bonds. I'm Arjun Patsati. And in Let's Talk Bonds, we take you through what are all the options available for investors in the fixed income markets in order to get the maximum returns as well as beat inflation, which is uh, which is hurting investors and because given that inflation is rising very fast, but interest rates are not rising enough, and investors are clearly hurting. Now, let's see what are all the traded levels of bonds and the retail inflation at around 7%, and looking to trend higher. The government bond yield, if you take the government bond yield, all the anything less than 10 years is still below 7%. And the 10-year government bond yield is at around closer to 7.2%. The 15 and 30-year and 40-year bond yields are at 735 to 750 levels, respectively. Even the state development loans are trading at around 735. But are these enough to compensate for rising inflation? Do investors have the risk to go for such very high maturity of bonds, given that interest rates can rise very sharply? Now they need to definitely search for other options. In the corporate bond space, also yields have gone up. The Bharat Bond ETF, which is index of all PSU bonds, the 10-year bond is closer to over 7.2%, while the 5-year bond is around 6. The 4-year bond is around 6.2%. Still not compensating for inflation. And in the corporate bond space, we had HDFC 7-year bond at closer to 7 quarters. So anything less than 7 years is below this level, and over even if you go for 10 years, it can be over around between 7.5 to 8%. Bajaj Finance 4-year bond was at around 7.4% levels, and still, if you go for the very high safety rate of these companies, the pickup over inflation is still not very high, and inflation can trend higher as we go along. So coming down, the corporate bond space, lower rated bonds are still trading at where they were, not really moved about. The AA and A rated bonds in my use the new fintechs borrowing uh, who are new fintech lenders who are borrowing anywhere between 8.5 to 10 or 11% levels. And but having said this, there is more and more inclination for issuers to now access the public debt market, as well as issue more bonds to retail. Earlier, many issuers were largely focused towards the institutional market. But now, given that retail investors are searching for options to earn higher income than inflation, which is not available in what they are getting at this point of time, then they are clearly wanting different more options, and more retail investors are definitely going to hit the private uh, retail market, and rather than the institutional market for funds. But in the last week, we had the Bharat Forge, the manufacturing high, strong fundamental company, issuing 3-year bond at 5.8%. The Indian Oil Corporation issued 2-year bonds at 5.84%. We had Avance Financial Services, which is an educational loan company. They issued 1-year bond at 8.04%, which is more for a retail flavor. There you have issuers like Precourt Limited, which is a style company, issuing 4-year bonds at 11.55%. The other issuers include real estate companies and others, anywhere in a range of around. Many of them could be the lower. The weaker ones are issuing bonds at closer to 18 to 20%. But depending on the strength of the issuer, we have also had iNurture Education Solutions, which is again a new fintech company. This is issued 3-year bond at 18%. So clearly there are more options coming up now. Traditional issuers, including Anand Jati, has been issuing MLD, and Edelweiss, all have been issuing MLDs and other bonds. Edelweiss is out there with a public debt issue as well. So clearly, investors will find a lot of options now coming up, anywhere in a range of around which can suit a lot of their preferences. But having said that, they must understand what kind of risk they're going to take in these issuers, because as more and more issuers in the market, then investors should be able to understand how to calibrate, understand the risk. And obviously, INR bonds is the best platform for you investors to understand risk, as we use our own proprietary model. In fact, today SEBI has told mutual funds to rate all their fixed income portfolios in terms of risk. INR bonds too does that, and we take all the best practices that is offered by SEBI to rate our bonds, and this does not, and clearly we do not only go by the rating agencies rating, and clearly I think investors would do better off to come down to INR bonds platform, check the risk score, and invest in any of these bonds. The yields are definitely can provide a lot more solutions to investors searching for income than what is being offered in traditional products. And as we go along, I think in the next few years, the biggest issuances will come into the retail space from the profit new issuers, and this is going to provide the best platform for corporate bonds market. And for a long period of time, even for over 20 years, the government, the SEBI, and the RBI have been taking some measures on how to increase the depth in the corporate bond market. But then now I think it's time, and definitely retail participation has to improve to increase the debt platforms. Electronic platforms are coming up to address the needs of the retail investors. Thank you for listening in. Do not forget to download our app, Quick Invest by INR Bonds. Check the risk score, see the issuer, invest in the bond through the app. There is seamless in-house investment process. You can access anything from bonds from which which is suiting your investment profile. And we are also traditionally running a lot of webinars and Twitter Spaces. In fact, this week on Twitter, I spoke about how to make money in fixed income markets. I'm doing a webinar on 23rd April, which is on how for financial advisors on how to provide solutions to investors to increase their own assets under advice and assets under management. So do download the app, sign into our Quick Invest platform, get all the communication that is required, and see the bonds that are listed on the platform, all the information, and take the best and improve your savings. Do follow us on Spotify, Apple Music, Apple Podcast, Amazon Music, and YouTube. And thank you for listening.